Hi, I'm Mary.
And I'm Carla.
And we're the Smiley twins. And today we're going to do a little bit shorter episode on a topic that excites Carla. So it'll be shorter.
This is not just lip service, by the way.
No, this is, I'm sorry. This is not just lip service. Welcome to another episode of Not Just Lip Service. We with Smiley Aesthetics. We should introduce ourselves too, shouldn't we? Because not everyone can see us. So I'm Mary. I'm the founder, one of the founders and CEO of Smiley Aesthetics.
And I'm Carla, her twin sister. And
yeah, but I don't know if you can tell off our voices.
I don't know. I sound.
We do, but us all the time. We sound.
Yeah, but I wonder if I think you can tell our voices apart.
I need to ask.
Because when you're listening,
I need to ask the guy who edits this if he can tell. I mean, obviously dialogue, but like I would still wonder. Okay,
he probably.
So we are going to tap into Carla's expertise and or one of her areas of expertise, and she's recently kind of discussed with several, I think a little cluster of our independent Medspa owners and some outside people on kind of their expenses and their P&L. And so she's going to go through and talk about it in layman terms and like define, which I have to cut in on her sometimes, define some of the things that she speaks to.
And as well
that not all of us understand.
And uncovering some of the things that I saw that were fascinating. I've been doing some stuff on Patreon about mindset with business, and like it's the wrong mindset.
Yeah,
so it's very interesting, related directly to a P&L.
Yeah, so it'll be very applicable, I think, to any business.
Yeah,
but yeah, that's a good point of some of the downfalls or the negative things that may not be viewed as negative if you didn't know, if you didn't look at them that certain way.
Yeah.
So with that being said,
what
is the profit in this?
So. Yeah, your P&L.
Yeah.
And so what happened is I do the individual reviews with injectors.
Great benefit of Smiley.
Yes. And go over, not somebody who's been in business for a month, preferably someone who's at 6 months or a year to try to see where they're at. And that's obviously strategic because 2 months into something, I mean, unless you're just, I don't know, haven't made a dime because you don't have a client, there's really nothing to look at, right? You can't look at anything there. But what I found is that I think people are listening to their accountants or their tax accountants or their brother or their dad who is telling them the basics of business as we understand it society, which is expense off as much as you possibly can.
Right. Well, hold on. But when you say that, that's not just like brother and dad. That's like the theme of when you look on Facebook or social media.
My business bought a car.
What's the main pro of, an
LLC?
I could expense off my nails because, this is an aesthetics business and it should be aesthetically pleasing.
I've nailed it.
So,
yeah. And so what the problem with that I found was, because that is true, right? So we look at a basic P&L, profit and loss statement. Huh?
To an extent, yeah.
Well, at the time, then
I get my nails on?
No.
On the business?
So, no. And again, this is kind of targeted towards younger businesses. This conversation, because as you get older, you actually do make enough money, typically in some businesses, that you are actually trying to spend that money on things that make sense. And no, you can't get your nails done. So, at the top,
wait a second. Hold on. Can we pause here?
At the top, you have income, and it's all the ways you make income. So for Smiley, revenues are revenue meaning income, our training, and our independent med spas, and our actual brick and mortars. Okay, so you have all this income in this big number up top. But then you have things that come out of that number, like do you discount anything, blah, 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 blah. It's called your gross sales.
And so hold on, your revenue for like a med spa.
Yeah, let's work off 100
skincare. Would you?
Oh, sure.
Would you break it down into skincare?
You can, but in a P&L, not normally.
So services, maybe retail and services.
Maybe you could. Yeah, sure, you could, but that's not really what on your P&L. It's really just your gross sales.
What brings in money?
Yeah, what brings in money? Your gross sales. So I'm gonna buy. Gross sales, and then you have below that you if you discount things or whatever the case is, you have different things. Some things might come out of that are income specific, not expenses, they're just income specific. So you literally discounted Botox. So it would have been
a new client special.
Yeah, if you did $500 of a Botox sale, typically you'll see it broken out that you did $9 a unit because it was it's normally 10, you did 9 because it was a new client. So you only brought in 400 or 450. And so you have a negative $50. It's still up in the income, but it's just showing you that this is what you would have made if you sold everything at the price you're telling me you sell it at. And it's going to show you discounts. That's an important number to look at, because are you discounting the crap out of your business, which I also found people are doing. And honestly, discounts can be, real quick plug on that, they can be lazy. Like you discounting to get new clients can work, but it's also lazy because like if you're like, I want to get one new client a week this month, and you get to day 6 and you haven't done anything, and you're like, well, I ain't got anybody, and I post it every day. Well, I'll just put a discount out there. Flash sale. It's like, yeah, that's a real cheap, easy way.
It also set you up for people to know you're going to do
exactly.
That. You do it too often.
Exactly.
Just wait for that.
And I just said it's cheap and easy. It's not. It's expensive is what it is. If you change that mindset, it's an expensive proposition to lower 64 units of Botox by $1 a unit. That's $64 in profit you just lost. I mean, straight profit. So that's a big deal. So anyways, then you have, so the bottom of your income, you have your gross income. Gross is always the total amount. So then you start going into other expenses, and normally the first thing is costs of goods sold, COGS, C-O-G-S, and that'll literally be, okay, I sold 50 units of Botox for $500, but that 50 units cost me $400. Great, so that's an expense. So you can see that number at the very bottom, your actual net dropping. So then I spent $2 on marketing and, $2 on lunch and $3 on, supplies, whatever. And at the very bottom, I have $42 left. Okay, 42 at the very bottom, it's usually bolded in black, and it says net profit. At the end of all of that, then you have your net profit. That's the number that an accountant will be like, no, expense things off, because you want that number to be as close to 0 as possible.
Okay, before you get into the why, you want that number to be close to 0. What about, like, where do you put, if you're looking at a PML, like, where does rent and where do the lights, the electricity, like, it's not going to go under cost of goods sold. So,
So underneath cost of goods sold, then you have just straight up expenses.
Because you can look at, like, okay, if I only do Botox, that's the only service I provide, I can look exactly what it costs me, what my net profit on, like, the Botox, like, service itself is.
Sure.
And then I can look over here, which it'll be a negative, all the expenses of running the med spa.
Yeah.
That number will be somewhere in the next, obviously, because you don't make money on them. You make it on the service. So you can break it down even further to see really what you're doing. But I mean, we're giving an overall picture here.
Yeah.
But I could see someone being like, well, where does rent come in?
Yeah, I mean, it's just an expense. So that's why it's all lined up, and it's literally just a summation of all these line items.
Yeah.
And at the bottom, and rent is on there. I mean, if you have a machine, if it's not just Botox or whatever, I don't know. Yeah.
So
whatever you want to say. Now, what I do want to say, like, you don't put. So I saw this happen multiple times. You bought $500 worth of product, and you put that on your expenses, but then you also put the $500 credit card payment that you paid off that $500 off your credit card on there. Yeah, you start both. You can't put both on there, right? It's one or the other. So you don't typically put the credit card payment
as an expense,
right? Because all of these things are
charge.
Yeah, but interest charge would be another one. Yes, that's going on there, obviously.
Okay, and then that made me bring up another question. I'm trying to think of questions that people who are newer would ask. So, on this P&L, if you were doing it, top to bottom of column, you might come down to your net profit on your services, and then so that's $100, and and then your rent and utilities, electricity, those are $25, and your insurance is $5, and so now your net profit.
Yeah. No, all those things are on a P&L.
I know. Yeah. I'm just saying, like, don't forget,
all
so
of those
the bottom
things,
number, that net, she said, when she does all the numbers, those are all up here, and that your bottom line
is literally the money that should really be almost left in the account in a lot of ways. I mean, it doesn't work out that way typically.
Close, though,
but
right?
I mean, for a young business, yes. If you're literally running money into an account and then you have your credit card and that's all you're doing. And then on income, you may have capital infusion. So you may have to put $5,000 into your business one month because you spent $10,000 to stock up on some product because next month you have 2-3 Botox parties. I mean, so it's not all at the end of the month, here's the numbers. Like businesses, that's why you have cash flow, which is a projection of where this will go over time based on what you've done in the past. So that's getting pretty deep. So let's
hold on. One more question that's not deep. So bottom line, you just talked about, and so you're about to go into more of that. When should a business, like, is it 3 months? I mean, you should be keeping up with this from day one, right?
Sure.
Because you can easily plug in things. You can even organize it later, but you can easily plug in numbers.
And there's templates in Excel.
And then I want to say something that you say often, like one credit card, one checking account, and then, we don't even, savings account as well. Checking account and a credit card account. You have one of each for your business so that you can easily see coming in and coming out and paying, and you use a credit card solely.
Yeah.
They're net, So, okay.
And you have to understand that if 1 month you buy 3 bottles of Botox and that party gets canceled, let's say, but you don't want to pay interest. So you've got to pay out that credit card. So you have to take personal money and put it into the bank.
Put it a capital infusion.
Put it into the bank account to use that bank account to pay that card.
That goes on your P&L.
Yes, of course it absolutely does.
Put on.
And what that is a basis in your business to then take distributions and pay yourself.
Weeds.
Yes, that is a weed thing.
That's the net profit.
But the point, that's why you want to keep up with it. Because I didn't really see any of that. I saw a lot of like, well, I had to pay the credit card off with, you know, and I'm like, well, did you? Yeah, you're negative, you know, $10,000. Where did the 10,000 come from? Well, I had to use my personal money. Well, where is that on here? Because that's important too. But yes, that is one step beyond. You know, but you want to make sure you keep up with exactly how much money you put into your business, which is why, personal infusion of cash plus $10,000.
Line item.
So anyways, why do you want that number to be zero? Because at the end of the year, if you make $50,000 in your other job, and then you made that number at the bottom is $10,000 in net profit in the black, in your black and red, black being the positive, then you are going to go to the IRS is going to say you made $60,000. But because you were a W-2 over here in your business, you paid taxes, as y'all know, comes out, and then you see Social Security, Medicare, and whatever the third one is. My gosh, I can't even think right now. But the other parts that come out, and they're much smaller. That's because your federal income tax rate is X. Let's just say 25%, and then 15.3% is self-employment tax. But what happens is you only pay half of that because the company is paying the other half when you're a W-2. But as LLCs, you don't have W-2 employees. You have to be an S Corp to have W-2 employees. You're the owner. You're paying. You're responsible for all of that. So if you take $5,000 out of the bank, or you have $5,000 in net profit, you don't have to take it out. Your business made $10,000. We were using that example. That is going to be reported, and you're going to owe federal income tax at your normalized rate of whatever your total adjusted gross income is, plus
25,
plus 15% on that additional money because you didn't pay it. This over here was taken care of, but this wasn't. So overall, on the $60,000, you put in, I'm making this up, $1,000, but you were supposed to pay $1,500. Well, you're going to owe $500 because it's going to go on your normal tax return as an LLC. Even as an S Corp, it's called a pass-through entity, and it passes through to your tax return. When you get to be a corporation, all that kind of stuff, things change, but that's not who we're talking about here. We're not even a corporation. Smiley Estates is still an S Corp. We're able to take advantage of all the tax benefits of a corporation, but they pass through to our personal income taxes. So, so and that can be a good thing. I mean, you know, that's why people talk about, I took, you know, a loss on my business. You know, I had $10,000 in net profit, and so I refinanced my car, and now, you know, I don't know, whatever. And so now because you can take that loss if you have a basis in your business, that loss carries over too. So if you put money into your business, you know, it goes pretty deep. The point is, especially on new businesses, you are having to fund it because you don't have any money in it. What I found was that 3 months in or so, what I saw on P&Ls is what you want to see at the end of the year, which was, I'm looking at my business, I've grossed $10,000 in 3 months, you know, I'm doing pretty good, but I haven't made a dime. But what I saw was expenses like lunch, gas, like something else totally random. Yeah, and I'm like, what? Okay, well, you're bleeding out, you know, of your $10,000, you spend $1,000 on gas and like groceries. Well, yeah, but I mean, I was traveling to an appointment that day, so I expensed it off. That's what my accountant told me to do. And I'm like, okay, I see now. That's the right thing to do towards the end of the year. And you got to be real careful about stuff like that. You know, is your chair in your house? You can literally rent your room to your LLC with a simple lease for a reasonable market rate. Yeah, sure, you want to do all those things, but is that reasonable to do in a brand new business with 2 months in, so that when you're looking at your P&L, you're like, yeah, I'm losing money. It's like, well, yeah, but you also you got to eat 3 times a day. So you fed
your lunch.
Well, I mean, but my point is, like, you're not remembering the value of the fact that you fed yourself 10 times in those 3 months. That would have been how much money out of your personal account. So that's essentially profit. Mm-hmm. You spent that money, or you got your nails done, or the gas. You filled up your entire tank. And did you have a tank's worth of appointments that day? No one had a tank. No, I mean, I don't think you could have a tank's worth of appointments in a day.
Yeah.
So you got that benefit of that half of that cost of half of the cost of a tank of gas that you would have normally had to take out of your personal. So when they were looking at it, they weren't appreciating the fact that they were paying for things in their life that they normally would have had to pay for otherwise. that needs to come out when you're personally looking at it, when you sit down with your husband and he's telling you you're losing, you know, you're flat, you hadn't made a dime. It's like, well, yes, I did, because I fed myself and I paid for my gas. And there were some other things on there, you know, that they were expensing off that made sense for the business, but it was also like very normal for a young business to have to pay for. Whether that's, you know, just anything. It was more the expectation that I can start my business and immediately expense off all of these things that are benefits that don't happen in the beginning.
Okay, so hold on, because this was, you know, huge thing for me. It's not that I didn't anyway, I don't need to defend myself. I didn't understand it. I just, like, you know,
she wanted to pay for a lot of things.
Our third partner, also, you know, just it's almost a difference in belief, and so whatever it you know, however you. Because accountants obviously kind of believe in this, some do, and then but Carla's point to me that was impactful was like, you're also kind of spending money, like you're sinking your ship before it can float. Like, you're spending money that if you even did a minor weekly projection for 2 or 3 weeks, you don't actually have.
Yeah.
And so and it's like revenue producing or not producing expenses, right? So like feeding yourself. Except if you want to take it some gross exaggeration of like death if you don't eat, but it's not going to produce any revenue. Now, in my case, if I don't eat lunch, I will not produce revenue. So I think that I should get to eat lunch every day on the business, but Carla disagrees. So, just kidding. But those non-revenue producing expenses are the ones that are the first to go or not even start to happen until it's necessary to help yourself in a tax way, which is not necessary probably in the first year, even in the first year of business. Now, depending on when you start. If you start January 1, you might be able to gain enough traction and stuff in your business in order to need to maybe consider expensing stuff off in your in Q3, maybe Q4. But hopefully a good accountant or Smiley will help you. We're not accountants. This is not advice. This is not financial advice.
Correct.
This is just guidance. But we could guide you in a way that we can, you know, look at this stuff like Carla does for our independent Medspas and give some guidance. Okay, you know, you're doing really well. You're in the black, you know, $15,000, and we got 3 months left in the year, and you don't look like you're going to spend that much money. So you need to start considering where you can maybe have some expenses that will benefit your business. So food is still dead last. Okay, that's like a last. Would you agree? That's like a last ditch thing.
Well, but yeah, what you do is you keep up with those expenses. Yeah, you keep up with those.
Or budget them.
You keep up with those expenses on the side, but you don't necessarily count them against your business when you're looking at it from a personal perspective. Like,
okay, you're gonna have to. So you could buy them with your personal card, keep up with them, and then expense them off later if necessary.
Yeah, you can definitely do that, or you can buy them on the business. But just know that when you're looking at your P&L and you're saying, I'm not making any money, those are not realistic expenses to have.
It's almost like added to your personal.
What
budget.
you're talking about is the moment you make money, and have any money whatsoever or cash in the bank. Yours kind of we're talking about where we had to shift gears was. Well, this is a business expense, so why wouldn't I use it? And I was and I was saying, like, guys, we could because if I have, sure, I made $100,000 this month, but in the bank there's 22. It's because I already spent before, like, by the time the month was even over, I already spent almost all the money, number one. But number two, I may have it in other places. So it's not necessarily net profit doesn't always mean, like I said, cash in the bank. So that doesn't, just because you made $10,000 this month does not mean you have $10,000 in the bank. There's a variety, and that's getting deeper, of places where that money has been. Or you have $10,000 on May 31st, but on June 1st, which was Friday, that's when payroll ran.
Yeah, so
on Friday, I had $10,000. Thursday, I had $10,000 in the bank, and Friday, payroll ran, and now I have negative $10,000.
Sure.
So it's a
that's a better because
it's a continuous thing.
Yeah, somebody can flip back to where I'm flipping into the people, you know, people probably listening. You know, you start losing. I don't want to say, you know, me. You start losing me. Some of the last minute of conversation. That what you just said kind of wraps it up in a nice bubble. It is the fact that just because May 31st is on a Thursday and June 1st is on a Friday, and you're looking at your month.
Yeah.
And it's like, oh, I am good. Like,
I mean, $10,000.
I'm gonna buy a new chair on Amazon tonight, May 31st.
Yeah. You made $10,000, but you might. Did you already pay your credit card? It's probably not. Did you already,
Yeah, it's just
like you haven't done any of those things. And so if you said, okay, on May 31st on Thursday, I made 10 grand this month. This is great. And you forget about any bill that's coming due. Maybe you have anything that you have to come to and pay that hasn't hit yet.
Yeah, 10 grand's a bad example. Maybe a 500. I mean,
I made $500. Yeah, whatever. But my monthly insurance or whatever is about to hit, or it hasn't hit yet, or the product that I purchased that I haven't sold, or it's on my credit card, or just a million things. Like that's the money that's sitting in the bank, or sitting on the bottom of that net profit. Like it's real, but it's almost not real. So okay, saying, but then the mindset, and you're right, it's a little bit separate conversation, but the similar that, well, it's a lunch and I was traveling. So my accountant was like, I should totally expense this. Like, yes, you should, but when you haven't even got your gosh darn business off the ground.
It goes back to I hate shitting on people. You could.
Yeah, you could. But you could also spend that $12 on boosting a post on Facebook for the next 24 hours and seeing if you get a client.
And that could be the same expense in a revenue-producing one at that, most likely.
Exactly. And I love the way you said that. I love the way you said a non-revenue, because I talk about now we're big enough where we talk about hiring FTEs, full-time employees, full-time equivalents, that are revenue producing versus non-revenue. Like when you get bigger, you start looking at it more like, yeah, the lunch isn't producing revenue. No, okay, maybe that's not as big of a deal, but
we're going to hire.
Is it a revenue producing expense or a non-revenue producing expense? And lunch ain't producing revenue anytime.
Yeah.
Neither is your nails.
Unless I get angry and, yeah, I'm just kidding. So wait, really quick. Taking this back a step. Doing it yourself, or like going back to like not getting too far in the weeds, because this one gets in the weeds on this. Back to newer businesses, or just really in your first year. So an accountant versus, really quick, do a brief overview of a bookkeeper versus a CPA versus a controller.
Yeah. Okay, so for everyone starting out, you're all those things, right? You should be.
Well, this is my point.
Yeah,
so Yes. Let me say, I'm starting out, and I have done I am ready. I'm taking my first client on Friday, and I have.
Yeah, unless you're
already got all these.
Unless you're opening a full-blown med spa, if you're just a standard like.
Okay, well, hold on. Let me give you that example. Okay. I'm actually, I did rent a space. I rent a scenario. I have a commercial lease. It's just 2 rooms. It's small, whatever. I have my first client Friday. I had to get I have several expenses. I put a little bit of my personal money into the business, all of it actually, because I had to, or whatever. So, do I need a bookkeeper? Do I need an accountant? What do I need? And what are the differences in those people?
Yeah, so that's a great question. But it all comes down to 2 things: capabilities and being honest with your self-evaluation, and then time. Are you somebody who has those 2 rooms and you're only doing it on Saturday and Sunday because you have a 5-day-a-week job? Like it's not really real. Some of these things are going to have to be outsourced. You're going to have to look at how much time you have available. And then from a capability perspective, being totally self-aware. I've never opened an Excel book in my life. Wouldn't even barely know how to do. I just wouldn't. And I'm not a self-starter in that regard. Like, I don't know that
I forget to document things.
Yeah, oh my gosh, I would never keep up with. I mean, there's all those little things, but do I think that you can absolutely have a simple? I mean, you don't have to know how to use Excel. They're cells. You type into them. Expense, gas, $42. Food, $12. We're not putting those on the expenses, remember, but. Product, $2,000, But but the point is, I mean, it's that simple.
You need to start.
You could use a Word document. You could use a piece of freaking notebook paper. But the point is, it all has to be electronic at some point. But yes, so no, you don't need. And what you're doing is you're being your own bookkeeper. That's what it is. That's what it's called.
So a bookkeeper is
somebody who keeps up with your transactions.
Okay.
And transactions are both debits and credits. Things that come in, sales, things that go out.
Expenses.
Yep.
And that's someone who's literally managing this. So what is an accountant, and what's the difference?
Yeah, so they're similar. So you don't have to be a CPA. You don't have to be a certified public accountant to be,
a bookkeeper.
Yeah, a bookkeeper, and vice versa. Accountants just have a degree and a different level of expertise. A bookkeeper can be self-taught. I mean, there are a lot of different things, but I mean, a lot of times they're one and the same a lot of times. So very similar things. So my accountant, a lot of times your accountant deals with more than just it can just be your business, but I mean, a lot of people's accountants deal with their personal finances. They're not necessarily the person that you invest money with. That's your financial advisor typically.
But they can be.
But a lot of people have a personal accountant, and that person is not necessarily a tax accountant. So then you have a tax accountant. Your accountant or your bookkeeper, those are pretty synonymous, are not going to be the person typically who does the taxes. But what they will do is they'll prepare the stuff to send to the tax accountant. Does that mean you can't do that? Of course you can. If you have this and you have this, receipts nowadays, guys, you don't have to have a receipt for everything unless you get audited. That's a big thing. Like, think about your personal taxes. I expensed off.
Well, how many receipts is required? If, let's say, IRS called today, how many receipts would I want to have?
That's a good question. I've never been audited, and I can't speak to,
Is there not like a law?
I don't,
like a percentage?
I don't know. I don't know the answer to that. I mean, the IRS will tell you. If they audit you, what are they going to want to see?
Google that.
Yeah, I mean, they're not going to want to see a $5.50 coffee charge. They're just not going to want to see that. You can have a company policy, your own LLC company policy, that anything under $100 you don't keep a receipt for. Like, that's fine. But like capital equipment and stuff like that, depreciation schedule, like bigger stuff, that's when they're expenses, or expenses that are questionable, like things like that. That's what's going to get you in trouble. And an auditor is looking at it from a lot of a subjective opinion when you get audited. Mm-hmm. There's rules, but there's also like, you charge gas 4 times in one day.
Your office in your house is 75% of your mortgage.
Yeah, you're renting exactly.
Yeah.
Your mortgage is $3,000 and you're charging $2,500 to your business every month.
Expensive office.
Yeah, that's interesting. So there are rules like that, and they're out there. Like, it has to be a market rate per square foot and stuff like that. So yes,
but then what is a market rate? That can be kind of subjective.
Oh, of course it is. That's what I'm saying. It's a lot of this is so subjective. I think a lot of it truly is common sense. Like, if I'm driving to an appointment at 10, 11, and 1, and I get lunch in between, of course. Or I'm working that day on my business.
That you should.
Yeah, but
I'm new business, but you
could.
A
lot of it is common sense, and people don't think outside of the box on that. Like renting a space, if when you start looking for expenses, which is when you start talking to your tax accountant, like, gosh, hey, you're in the your net profit right now is like 11 grand. Like
you're in the aesthetic business, your nails should look better than that.
Yeah, but remember, that doesn't necessarily mean you have an 11 grand in the bank. Like, it's just so interesting. Yeah, how. People don't understand that. But let's say you do. Let's say you got cash in the bank. Like, okay, is there an opportunity? Is that when you want to finance a machine? Because again, when you talk about capital equipment, the expense for the capital equipment hits and then depreciates over time. And again, we're getting a little bit in the weeds here, but it's not like if you buy a $150,000 machine, it necessarily hits, like, it doesn't hit $150,000. And so you go into the red $140,000. So there's schedules for that. That's what your tax accountant is doing. Your bookkeeper prepares, I have all these things. I have this expense every month. Here's my blah, blah, blah. But a tax accountant will do depreciation schedules, appreciation schedules, if you have those, stuff like that, to get what is your actual
strategy, maybe with the accountant.
Yeah.
Our bookkeeper is amazing. And
we have a good one in particular. And it's okay to lose money on your business, but the point is, if you like, I took a loss again, and it's like I'm paying for all of my business and some of these other things, and I'm real happy with this, and I also do take out $500 a month, which, by the way, that's not an expense in an LLC. An owner's distribution is not an expense. So if you take $1,000 out of your business to pay for something personally and it's self-pay, you're paying all the taxes on that, and you're also not getting to expense it out of your business. Like, it is annoying.
Star that.
Yeah. So it's not considered expense. So
we could do okay. So because we're running out of time, I think maybe we could do a part 2. I think that that's a little bit more. And once again, we're not Carla is not giving any type of advice. It's just guidance. But her breadth.
Let me finish what you asked. So real quick, because I know we only have a couple minutes. But you asked the difference in the people. So I'm sorry, that was the tax accountant, which is different than the accountant. I think that's a key thing that people don't understand. Because a tax accountant, if that's your buddy that you're talking to, all they're trying to do is get that bottom number basically as close to zero as possible so that you pay the least amount of taxes. But that's not the same as maybe your accountant who's like, hey, listen, next year you want to buy a building to open a med spa, your own med spa, or you want to rent an entire med spa. We can't show negative numbers every single month and year.
That's true.
Because the bank's going to be like, what the hell are you doing over there?
And then, or you run into my situation where I can't buy a house for, 2 years.
Exactly. Because And now I will go
but in a positive way.
I'll go one step further and say, a bank will sit down with you and say, here's your expenses. And if you show that you spent all that money and more on marketing,
business.
Yes. Well, but if it's travel and entertainment, which is the line item that the government will use, and that number is, 10% of all the money you made. It's like, okay, what you doing over there? What are you doing there?
We're not going to trust you.
You're going to AmSpa and spending, $5,000 on planes and that's all
dinner.
And everyone's like, that's an expense. And I'm like, yeah, that's
meals are expensive.
Yeah, that's all cute if you've got if you're making the money to expense it, and if you're not taking that money and putting it back into your business first and foremost to be able to afford those types of things, that's what is missing.
And that is
understanding
the difference. You get into a budget where if you just feel that, I don't know, that's what the budgeting conversation can make all of these things.
Once you're making money consistently.
Yeah, once you have it consistent, or even after, if you're not making money after a year, but you can still have so you know where things are going.
Sure.
And then you're putting in strategy and stuff. So I'm spending too much on,
right.
I don't know.
I wouldn't put lunch and gas. And I would, it's like a personal business expenses is really kind of the terminal. And it's like, I almost like they're on your P&L, of course, whatever, but like it's almost separating those out and deciding.
Yeah, I was talking more about budgeting for the conference at the end of next year.
Sure.
That's where that strategy and budget can come into. But
instead of spending $30 on lunch 3 days a week, that $30, do you want to take $60 of that $90 and put it in your AMSPA or your whatever?
Which that right there is one of the huge benefits of a P&L, which I don't think I need to say this, but like, why do a P&L? That right there.
Because I spent $300 this month on lunch.
And I could put that over the next 6 months here, and I can attend a conference for free. I could attend a conference without affecting
and it's expensed, and it's all the same things. Yeah.
So let's do a part 2 on this. Okay. Because she'll know we're gonna do a part 2. This was meant to be high level. I think we'll do we'll really look at we'll get our thoughts together on like the topics we discussed today and elaborate on them. And then the comments and questions, as always, are very helpful. But maybe we could follow this up next week, our next podcast. I almost am going to guarantee it. It's going to be a part 2 with a little bit more, maybe the same topics and a little bit more deeper dive, because I can see where I have the questions that I feel like are coming to me telepathically, and that we can dive in a little bit deeper into this.
Thank you.
Holding on to 3. But I think that's the best thing to do, or we'll never, we won't be able to wrap it up, or it'll be a 2-hour podcast. So that's what we'll do next week.
Send any questions you have.
Yeah, send those questions, and then we really will run back through this podcast and kind of elaborate on each point.
Yeah.
On what, and Carla can elaborate a little bit more on it.
Because the next thing is a controller and a CFO, and I laugh at the
budgeting.
Well, and the people I see that have other people they're probably paying call them their CFO, and I'm like, oh dear Lord, we're getting into some really cute terms that are just so unnecessary.
Well, we could go on title. We could go on a little tangent on titles, which we have tangents. So we'll kind of speak to some of that stuff, using the framework for another financial conversation.
Yeah.
Okay. So as always, thanks for joining us. A lot of stuff that the financial and stuff, and some resources for some of that nitty-gritty stuff, some P&L stuff, that's on Patreon. I mean, I know I've talked about Patreon every week because it's extremely valuable for
some mindset stuff that people like to ignore, but like the more and more as we go down this path, I'm realizing it's truly mindsets.
Yeah.
Over sometimes the lack. It's not lack of knowledge, or it is lack of knowledge, but the mind. We got to start with, before we give the knowledge, we have to start with the mindset.
Yeah, I mean, you get into social media and stuff, and just read some very shallow stuff that some people can post about.
Yeah, all you see is sex.
Like us on the negative stuff or the whatever. Then you can look at some bigger names like, the Dave Ramsey and Tony Robbins, and mindset is their core focus. So let's, we can, but our Patreon, the business side of it speaks to a lot of the stuff. A lot of it's about money, because that's a lot about what business is. So we do the legal and the clinical in there, of course. So go check it out. It's just patreon.com/Smiley Aesthetics, $50 a month. It's just totally worth it. You can do an annual membership for even cheaper. And then if you don't like watching us on YouTube, then go, we're on Apple and Spotify and Amazon Music. And then if you did listen to this and you're hearing me now and you listen this far, if you could just click the like
button. It was helpful at all, please
share it. Yeah, we implore it. I will grovel. Like we're trying to build our community and build this YouTube and build all of our podcast following and stuff just to benefit people even more. So please do that. And then we will do part 2 to the financial part 2. Yeah, next week. So thanks for joining us.
Thank you.